All right, big question for you today. Do you think that a payout ratio of 100% could lead to a safe dividend? Dividend growth investors, bonjour. My name is Mike Yehu. I'm the founder of Dividend Stocks Rock, and I'm also a passionate investor. And today we're going to do a deep dive into the payout ratio. A lot of investors, they want to have the dividend. They don't want to suffer a dividend cut, which is totally fair. And therefore, they discard all companies showing a payout ratio above 80%, thinking that the dividend would not be safe. So today we're going to look at 4 companies, 4 different cases where the payout ratio is above 100% and still this business found a way to increase its dividend year over year. All right, so let's get started with the first one. Broadcom, ticker AVGO. Current payout ratio 159%, but the cash payout ratio is at 46%. So already you have a hint that maybe there is something underlying here. So what you need to know is the business model of a company before looking into financial metrics. So you have to know what you own and why you own it, right? So Broadcom has been known to grow by acquisitions year over year. Actually, it's kind of funny because the ticker is coming from its previous name, AVGO, that came into Broadcom with the merger of that company. So what you see on this graph is the company has been a serial acquirers over time. And when you acquire businesses, what it means on your balance sheet is you're going to have a lot more amortization, right? Because you're going to amortize those costs. And by doing so, you will reduce your earnings. And therefore, from time to time, you will show a very bad payout ratio. But it's not about the inability to distribute dividends, but rather because on your balance sheet, you have lots of amortization and other non-cash event. When we look at the dividend triangle for Broadcom, we can clearly see that the revenue keeps on increasing, showing that growth by acquisition method. And on top of that, right now, they're being fueled by a lot of AI hype. But when you look at the earnings per share, you can see that it's more cyclical. It goes up, it goes down, and it's usually being affected by those acquisitions. In the meantime, the dividend increases every single year without any doubt. So in this specific case, you better off look at the cash payout ratio instead of the payout ratio to have a good idea if Broadcom is able to increase its dividend in the coming years. Now moving on to the second example, Brookfield, ticker BN. This one shows a payout ratio above 100%, but a cash payout ratio that is negative. So it's even worse than Broadcom because on this point, the dividend doesn't look safe at all. So now you have to look at what's going on with this one. And it's kind of interesting because Brookfield has been known for being one of the rare companies showing consecutive dividend increases in Canada for several years. And the secret here is, again, in the business model. So you have to understand that Brookfield Corporation is an asset-heavy manager. What does that mean? Is because they charge fees to pension plans, retail investors, other financial firms to manage their money. But on top of that, they are using their own capital. So from time to time, they will invest massively into businesses, generating amortization and, of course, cutting down the cash flow. So instead of using the payout ratio or the cash payout ratio, in this case, if you look at their financial statement, they will provide you with the distributable earnings and the distributable earnings per share as well to determine a homemade payout ratio. And now you can see at the bottom of this chart where the distributable earnings per share is at 88 cents. Well, when you think that Brookfield is paying a very small dividend of 9 cents a share, there's plenty of cash flow here to pay the dividend and keep the business rolling and still invest in new projects. Finally, when you look at the dividend triangle, this one is quite tricky. And this is actually a signal that you should not use earnings at all when you analyze Brookfield. As you can see, the revenues are cyclical, but it's going up most of the time. But for the earnings per share, it's all over the place. It goes up, it goes down, sometimes it's negative. And on top of that, you have a feeling that the company actually cut their dividend in 2023. Well, actually, it's not the case at all. The thing is, the company made spin-off, and I told you several times, it is a complex financial structure. So before we had Brookfield Asset Management, so BAM, that has been spun off from Brookfield Corporation, and then they changed the dividend payments. And this is the reason why you see it as a cut. But in reality, the dividend kept on increasing, and the earnings per share is not the right number to monitor to analyze this business. So you can learn all of that by monitoring quarterly earnings and learning how to read those. I actually have a webinar today, this afternoon, and if you're too late watching this video, don't worry, click on the same link and you'll see the replay right away. So it's a webinar about how to read earnings and understand price volatility. So why the price goes up, why the price goes down after the earnings are being reported. So you'll know how to learn about that and how to analyze a stock using the dividend triangle. So you can go to dividendstocksrock.com/webinar for more information and to watch the replay as well. So we always say that cash is king. Well, in this case, it seems that it's going to struggle the business big time, right? So Enbridge, ticker ENB, is showing a payout ratio above 100% and a cash payout ratio above 100% as well. So 150 for both. So you may be thinking how this company can go decades after decades and increasing its dividend all the time. That's kind of crazy. Well, again, you need to dig into the quarterly earnings. You can see how it's important to understand them. So when you look at Enbridge and you think about its business model, it's capital intensive, which means they have to spend billions of dollars to maintain and grow their pipeline business. It's super safe. They have long-term contract. They're racking cash flow all the time, but they're using that cash flow to invest into new projects, which we also called capital expenditure or CapEx. So the CapEx that is being projected for the coming years is in the sum of 32 billions. So of course, Enbridge is going to use its cash flow, but it will probably require some debt. And when you have a higher debt to invest in your CapEx, well, what happens is therefore it's going to hurt your free cash flow and hurt your payout ratio. So again, you probably guessed it, you cannot really determine if Enbridge dividend is safe by using the payout ratio or the cash payout ratio, but rather go for the distributable cash flow or distributable cash flow per share, so the DCF per share. Here's the example where now you have the adjusted earnings per share of 65 cents, right? The latest dividend payment for Enbridge was 94 cents. So of course the payout ratio shows at like 145 just for the last payout for the last quarter. But when you look at the DCF per share, it's $1.33, which brings the DCF payout ratio below 75%. And this is their target between 65 to 75% of DCF payout ratio. So you can see that Enbridge is able to A, maintain their pipeline network, B, invest in growth, and C, increase their dividend by roughly the 3% that they have been offering over the past few years. So again, when you look at the dividend triangle, you will see that revenue and earnings are going up and going down. It's quite cyclical, but the dividend keeps on increasing. So then when you have crazy ratios like this, but you see that the dividend keeps on going up, now you have to ask yourself, well, probably I'm not looking at the right metric and I should do some more digging and understand a little bit more about how the business works and, of course, about the metrics that they are monitoring. Between you and me, the thing is, when you look at distributable earnings per share for Brookfield or the homemade calculation of the DCF per share for Enbridge, the problem is that they're all homemades, right? They are based on management calculation. You have to trust them. They're not GAAP numbers as well, so it's not generally accepted accounting principles. You have to be a little bit more cautious when you deal with those companies. Not saying it's not safe at all, but you have to consider that in your investment thesis and before you are about to buy any of those stocks. So we're going to end up with another one that is quite interesting. It's in my portfolio, Telus, with a payout ratio of 233%, and yet they increased their dividend by 3% this year. That's kind of weird. Cash payout ratio, though, is at 79, which is pretty decent. Again, we see Telus as a capital intensive business. They have to spend billions to run the operation, maintain the network, and improve it as well. So it it hurts a lot when you look at the earnings in terms of amortization. But when you look at the payout ratio, and you can see that those calculations inside the quarterly statement as well, as you can see right now, it was actually at 82% in 2024, now at 75% in 2025. So the company is able to run the business, assure growth, and increase the dividend at the same time. When you look at the dividend triangle, though, you will notice that the revenue keeps on increasing, the earnings have been hurt. It has been hurt not only by amortization, but also by higher interest rates. That has been a major problem for telcos over the past few years. And at one point, a lot of telcos realized they cannot continue to just borrow more money every single year as the debt is piling up, interest charges is increasing, and then it struggles the business. That led to BCE cutting their dividend earlier this year. For Telus, their situation is a little bit better. There's a little bit more light at the end of the tunnel, but they're not out of the woods yet. And this is why the stock price is still struggling. On my side, I continue to monitor the cash flow metrics. As long as they offer a dividend increase and the cash flow metrics tells me that the dividend is safe, I'm going to keep my shares. Of course, I'm not super happy about the performance, but that's part of the deal, right? Sometimes you win, sometimes you lose, and sometimes you just have to be patient. So overall, those 4 companies have shown more than 10 consecutive years with dividend increase, every single one of them. And the reason is because once you understand the business model and you understand where to look, you realize that the dividend is actually safe. And this is also why I do not use a payout ratio minimum or maximum metrics when I pull out a stock screener. I rather filter by revenue growth, earnings per share growth, and dividend growth. Even though it's not perfect, I don't want to discard amazing companies like Broadcom, for example. Even Brookfield and Enbridge has been paying very nicely and has been on quite of a run up as of late. So you can see that focusing on a payout ratio is a good thing, but as a second or third layer of analysis, not in the first place. So, all right, guys, do not forget to watch the replay for the webinar if you missed this video this morning at dividendstocksrock.com/webinar. And we're going to talk again next week. Until then, don't forget to stay invested.